Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Rob Everett, who's the CEO of the Financial Markets Authority. Welcome in, Rob. Good to see you again.
Yeah, thank you.
Lots to talk about as ever, so we'll try and keep it focused. Look, we'll kick off obviously with this. We've just had this Financial Advisors Act review. Now, the government's made the point that commissions won't be capped or banned. You obviously did a very interesting report recently about advisors selling life insurance and churn and commissions and the impact that that's having in there. So I guess initially just keen to ask you whether, from an FMA perspective, is not the lawmaker but the police, I guess, of the law, whether you would have liked to see more of a crackdown in the commission area.
Yeah, so I completely acknowledge that commissions drive a lot of conflicts of interest. They can drive a lot of bad behaviour. I think the problem with commissions is it seems like an easy solution to ban commissions. It seems like the obvious thing to do. But where that's been tried, such as the UK, it hasn't worked. And it's actually had counterproductive impacts, partly because people won't pay for advice. All the studies in the UK say that people won't pay up front for advice. I don't think New Zealand's any different. So banning commissions seems simple, but actually if we want people to get more advice, which was part of the objective of the government review, I think banning commissions looks good, but actually works badly.
Now, you also, after you did that report on the life insurance sector, we had some people saying, well, hey, this is really interesting, glad they're doing this, but what about banks and sales practices among banks? Is that an area that you might look at as well?
Absolutely, and I think if you look at our strategic risk outlook, we've always focused on sales practices more generally. We felt when we looked at the insurance piece that we needed to focus our attention for that report on the financial advisor channel. We have looked at direct sales and Kiwisaver, for instance, and that continues to be a priority of ours. We just felt the issues at play for the insurance through financial advisors and bank and insurance company direct sales were different, and the data was different. So that report was specifically targeted at one channel. But absolutely, we're focused on sales practices right across the big institutions.
So, I mean, we did see that Kiwisaver report, obviously, and that certainly that's a market dominated by the banks. But in terms of the banks, qualifying financial entities, anything more immediate in the pipeline on that sales practices?
We've still got some dialogue that's ongoing with several of the big institutions just around our general monitoring of their sales practices and the design of their remuneration. We don't have anything planned in the near future in terms of a big report of the scale of the insurance report, because those things take a lot of time. But yeah, the direct sales very definitely on our radar, so we'll keep pushing at that, and I'm sure you'll see more from us around sales and advice more generally.
Okay, and any specifically new concerns or improvements you've seen there of late?
In the direct sales?
Yeah.
Well, I think a greater understanding, which actually you see reflected in some of the philosophy in the FMA review, a greater understanding that the institution is responsible for the design of the incentives, the design of the training and the conduct of their employees. So I think we've seen that recognition, but we're still waiting to see that really flow through into how people interact with consumers.
Now, in the Financial Advisors Act review too, there's a plan, I guess, to simplify things in terms of the types of advisors. So we've got the authorised financial advisor, the registered financial advisor, and the qualified financial entity classifications now.
Yeah.
And the government's looking to move to financial advisors and agents instead. Yes. Curious to see, what you think that means, I guess, for consumers, disclosure to consumers, and standards of financial advice.
Yeah. As you know, I've long felt that the financial advice structure was much too complicated here, both for users and for the advisors themselves. So in the short term, this may not look like much of a simplification. My sense of what's being proposed here is actually in the long term, it will simplify things. It will simplify things by dividing things effectively into financial advisors or those who aren't financial advisors. And for financial advisors, what it will do is brings standards up to a minimum level in terms of conduct and competence and training for anyone who's holding themselves out as giving financial advice. Right now, you've got that slightly bizarre feature we talked about in the insurance report, where an RFA and AFA can sell the same product but have completely different standards of required conduct. So there's been a lot of focus on AFAs in the last 5 or 6 years, and I think the proposals from the government, what they are designed to do is drive up the standards right across the piece. So whether that's what would previously have been called RFAs, or indeed just agents within the QFE structures, because the QFEs have to take accountability for what they're doing.
Now, the government's also reviewed the Financial Service Providers Register, and they have come out with this, concept that to be registered on it, companies will have to have a strong connection to New Zealand. Obviously, the FMA has powers to deregister those who are deemed that shouldn't be there, or are bringing, New Zealand's reputation into disrepute by being there. Will this strong connection to New Zealand, will that be a good enough power for the FMA?
I certainly hope so, and we've pushed throughout this process for the strongest possible connection to New Zealand and the best definition that we can come up with for basically doing business or providing financial services in New Zealand. There's no logic really in having a register for offshore entities who aren't doing business in New Zealand. So we're going to push quite hard, and obviously the devil's in the detail here, but we're going to push quite hard to see the closest connection we can get to actually providing business, financial services business in New Zealand.
Now, obviously this is an area I've looked at quite closely, taken a bit of an interest in. One couple of things that have struck me is to simplify it, could we make it that everyone on the Financial Service Providers Register has to have a licence? Or, do we even need to register anymore? Because we've obviously got the Anti-Money Laundering, Countering Financing of Terrorism Act in place, and we've got a lot of licensing that the FMA is doing now of a lot of legitimate financial service providers anyway. So do we need to register?
It's a good question. One of the difficulties with the register is that it was designed, pre-FMC Act, pre-AML regulations. So actually a lot of the original purpose, you could argue, has basically made it somewhat redundant. And I think there probably are other mechanisms that you can catch those financial services providers who aren't licensed in another way. But the MB view is that the register still provides some purpose. It still provides some information that's of use to consumers looking to look up firms. I think so. In their recommendations, the basic approach is to keep the register and tighten it up. I think you could argue that maybe the register as a whole is not sufficiently useful at this point, that you could have gone a different route, and that actually probably would have been where we would have preferred to go. But MB's of the view that we should keep it, and that's where I'll end up.
You mentioned there are other ways of capturing the non-licensed entities on there. Can you elaborate a little on? Well,
I think part of the objective of that register was to have a single place where anyone providing financial services could be covered, and it is true that if you leave it with a sort of multiplicity of places people have got to go to find providers, that does get complicated for people. But the reality is people tend to look for providers by the service they're providing. So actually people tend to go to, is it a financial advisor I want to look at? Is it a fund manager? Is it something else I want to look at? So actually I think there is a way of having the appropriate lists of those providers available to people who want to look for them, which would also meet the FATF requirements about having a register, which doesn't mean you have to run something quite as big and unwieldy as the FSPR. But as I say, the reality is the direction is to keep it and to tighten it up, and we're pleased with the aspects of the tightening up that we just talked about in terms of connection to New Zealand.
Okay, now we'll move on. The Financial Markets Conduct Act, now that this is obviously the key piece of legislation that's come in since the FMA was formed, described as a once-in-a-generation change, a new era for financial markets. So. And it's been, this is, I guess, the bread and butter, the key area of focus really for the FMA. You're nearly through the implementation phase now. It's taken obviously quite a lot of time. It's huge changes. I guess one of the key questions here is, who and where are going to be the focus for the FMA going forward?
Yeah, you're absolutely right. This is the core for us, the mainstream for us. and it has been a long time coming. So we're almost there with the fund management licensing will be completed by December. And so at that point, we have our full remit, we have the full horizon. So the focus there will be on how a kind of modern supervisory regulator influences behavior, influences conduct, how we look at what's going on in the licensed sectors so that we can target our resources properly. So, for me, it's about how we develop the relationship that licensing starts into a relationship with the industry where we know where we need to be looking, we know where we need to exert our influence, and that everyone understands what we're trying to achieve. So it becomes a steady state of looking at conduct, looking at systems and controls, looking at governance, where hopefully the legislative framework stays in place for a while. People can see with some consistency and stability that it's not going to change. I think that's really critical, and that we get to start moving the needle on the dial in terms of how financial services treats its customers.
Now, conduct has been in financial services has been a big issue globally in recent years. I think notably across the ditch in Australia, it's been a big issue. That's obviously going to be a key area of focus for you.
Yeah.
What are you seeing in that area at the moment, and what are some areas maybe that some of the financial service providers could improve in terms of conduct?
Yeah, if you look at what's going on in Australia at the moment and what's been going on in other parts, people don't trust financial services as a whole, and there's only a certain amount a regulator can do to lift those standards of confidence. Actually, the industry are the ones that really need to respond to those surveys and the customer feedback. So I think it's about the industry not being complacent, that somewhere like New Zealand, the industry can make decent money effectively by just turning up because of the competitive nature of the market, but relentlessly focusing on the customer experience, and are they delivering what the customer both needs and expects, and if not, reacting to that. That's the way, if the industry approaches things with those mindset, my own view is that most of the rest falls into place. And some of the heavily prescriptive legislation you see in the States, for instance, shouldn't be necessary. But that requires a regulator like us to be convinced that at the very top of all of those firms, that's actually the mindset, and that will feed down through the organization. So, for us, it's that relentless focus on, if things are going wrong at the ground level, which they often do, why is that? How are they reacting to it? What are they changing to make sure it doesn't happen in the future? So, I think it's about an industry not being complacent about the fact that most people have to interact with financial services in some way, and actually making that more of a choice.
One of the obviously key things that's been going on of late is obviously the share market's booming, the housing market's booming. People are raising a few red flags about how long this can all go on for. I guess from your perspective as a regulator and looking at conduct and that type of thing, I guess when the old Warren Buffett saying, when the tide goes out, you see who's been swimming naked. If things do turn, do you think that is going to be a time when we're going to see more issues for the FMA to be acting on? Yeah,
for sure. And in a market downturn or even a market crisis, that's when the lens tends to focus on what the regulator's been doing and why they weren't able to prevent it, which is why we've talked about it being so important that you build the foundations through a reasonably benign environment that we've been in New Zealand, so that when those market downturns come and people lose money, the focus is on market cycles and how to protect yourself against market cycles, rather than how they were treated by the provider of the financial services or whoever they invested in. So it's really critical that in the good times, this focus on how the customer or the investor is being treated needs to happen in order to survive a downturn, because as a relatively new regulatory environment, what we really don't want to see is, in a downturn, everyone go back and ask the same questions they were asking 5-6 years ago about how could this have happened. So people need to accept that markets go up and down, and that's a normal part of the investment cycle. And with some of the asset bubbles we've got now, the down could be quite steep. But to feel that that's a normal market environment and that the damage has been as limited as possible, and it hasn't been driven by poor treatment of customers.
Well, thanks a lot for that, Rob. That's Rob Everett, the Chief Executive of the Financial Markets Authority, and I'm Gareth Vaughan at interest.co.nz.